Good morning, buenos días a todos. Konnichiwa, yoroshiku onegaishimasu. Good morning, bon dia. Thank you for coming to our GVC Gaesco 300 Places Worldwide webinar. Just briefly mention to you the agenda for the webinar. We are going to divide in 4 sections. First, global tourism as a form of investment and rationale of GVC Gaesco 300 Places Worldwide strategy, driven by Jaume Puig, CEO and CIO of Asset Management. After the first section, growing demand and opening of borders, Ignacio Hosta, Senior Analyst and Director of Information, will be the speaker. Then the third section, portfolio valuation. Paul Compine, Senior Analyst, will explain what we have done, especially during 2020 and until today. Finally, sector and fund outlook for 2021 to 2025. Jaume Puig, as the fund manager, will give you a deep explanation of our view in this niche strategy. Then after the webinar, we are going to Q&A. So please, if you like to proceed with any question, do it through Q&A in the bottom of your screen. You can do it anytime. Please do not use the chat for this purpose. It's as it's being disabled. If you ask through Q&A, the questions not resolved with this event will be answered shortly in the following days. Now to start with the purpose of this webinar, please, Jaume, the audience are ready for the takeoff.
Thank you. Thank you so much, all of you, for joining us today. Let me explain you very briefly why we created this fund in 2014 and which is the investment case of the fund. Okay, so just a few words about the demand and about the supply. Then, so let's go to the main point. So first of all, let's talk about the demand. Okay, it's very simple. From one side, world population is growing from 6 billion in 2000 to 8 billion people in 2025. But most important, more than that, the key thing is that the percentage of the world population who is or can be considered middle class is growing. It was lower than 30%, I mean, in the 60s, and now it's higher than 60%. And this is very important because as you perfectly know, I mean, the middle class is the consumer class, okay? So if you go to the next slide, here you can see in the year 2009, 1.8 billion people all over the world could be considered middle class, and is expected that in 2030, this figure reaches the 4.8 billion people being considered middle class. As you perfectly know, Asia is the main contributor of this, with being in the year 2030, 2/3 of all the world population middle class, okay? So if we go there, then we can see when we launch the fund, which is a global tourism fund. So it's not investing. Let me distinguish between local tourism. We go to any of the places in our country which are nice to go. This is local tourism. But we're investing in global tourism. So it is people who goes from one country to another in order to make tourism. The thing is very simple. If you go to your country, you go only to nice places, plenty of nice places everywhere. But if you go to another country, you are looking for different things. It's for unique places, things that you cannot see in your own country. Okay, so our fund is about global tourism. Okay, what we see about the global tourism in figures. Okay, when we launched the fund in 2014, all over the world, 1.1 billion people had been global tourists. It means that they spent at least one night in one country that was not their country, international travelers, okay? But by that moment, it was expected that it was going to be reached the 1.8 billion people by 2030. The reality has been much better than that. In 2018, it was 1.4 billion people. In 2019, 1.5 billion people, and 2 years ahead of all the previous expectations. So what we can see of this phenomenon is that is growing, is increasingly growing. We can see here as well in this if you look at the graph left-hand side, how resilient it is. If you look at the 2009 crisis, it was the big crisis, Lehman Brothers crisis. The number of international travelers only went down 1 year. And in 1 year, in 2010, it was fully recovered. So we are talking of something that has a lot of strength, okay? Well, if we go to next slide, we can see here the most important thing. This is not a usual sector. This is something that is growing much more than the world GDP. As you can see here in the figures, GDP world was growing at an annualized pace of 3.6%, but the international arrivals more than that, 4.3, and more importantly, the international receipts, so the expenditures that are done by the global tourism are growing at 5.6%. So clearly, this is growing much more than the world. Needless to say, you can see in the left-hand side chart that you can see the main contributors, so the exporters, the main exporters of global tourists in terms of expenditure. You can see here China, US, Germany, UK, and France, okay? But the key thing is that all this is growing all over the world. So if we go here, we have to consider as well next generation, okay? If we look at baby boomers or millennials, for instance, here you have plenty of statistics. Let me just give you one figure, okay? You can see that baby boomers are doing per annum 4.4 travels per annum. But millennials are traveling more. They're traveling 4.9 times per annum. But the most important thing is the international travels. Okay, baby boomers are doing 1.5 per annum and millennials 2.7. So what does it mean? That in fact, this generation, current generation is traveling a lot, but next generation are going to travel even more. Here we can see plenty of information here, just to mention you the main points that traveling is being considered by young people all over the world, doesn't mind if they are Chinese or US or UK, one of the main destinations of the expenditure, even more than purchasing a home or a car, okay? So we can go to next one. And we can see, okay, what's going on? Okay, you know, mainly probably you know Spain, that it's one of the main touristic countries all over the world. Well, in fact, it's #2 worldwide in terms of number of tourists coming. The #1 is France. And it's #2 worldwide in number of expenditure made by the tourists. #1 is US and second is Spain. Nevertheless, it's #1 worldwide in terms of this competitiveness index. It takes into account lots of things, safety, infrastructure, whatever, but it's #1. So it's a phenomenon that we know, and it is amazing because most of the information we get it from, of course, listed companies, but also non-listed companies, many clients. We have lots of information about this sector. Okay, so from the demand side, we can say that this is increasing demand, growing much more than the whole world. The thing is, let's go to the supply side. And here is the best thing of the equation. Why? Because if we look at things that people want cars, watches, smartphones, whatever, anything of this can be produced. But if what people want to do is to go to those places, you know, the breathtaking places, they are a limited amount all over the world. That's one of the key questions when we realize. So the supply is really much more restricted than you could think. Amazingly, of these 300 places, here you have, we were doing some research on which are the 300 places more visited by the global tourists. And it's amazing because if you are a people, imagine living in Nigeria or Kazakhstan, and you are entering into the middle class, we already know where you are going to travel, okay? Of course, here you see the main 60 destinations, but you can see New York, Paris, Venice, Grand Canyon. None of this is going to surprise you. The amazing thing about this list is that this list is very robust. So it's not changing too much. From time to time, you have new locations who enter into this list. For instance, Dubai was not in this list 20 years ago. Now it is, okay? So these kind of things. But we have done our research on which are the 300 places where the tourist is going. And we realized that we already know where they will go. Okay, so once we have considered that, we started to look at how many companies worldwide were there that we could invest. It was a bit more than 1,000, 1,300. And here you can see the sectors and the locations, mainly 45% in the US, 40% in Europe, but all over the world. So this is our investment universe. Now, let me a few words about how we do it, okay? So the thing that we do it is the following. First of all, we do a primary company research. What does it mean? We are not investing in companies just because they earn money. We want this kind of companies which are special. We have niche. We have something differentiate from the others. So earning money is not enough for us to invest in the company. Then apart from that, the second step, once we have these companies identified, is some qualitative analysis. We do it by interviews with the management. Here you can see in the last years, 5 years, almost 800 company visits we have done in the last, you can see in 17, 18, 19. Of course, the ones in 2020 and this year are not as usual because normally they are face-to-face meetings, but in this now, last year and this 1 year is they are only by internet, okay, by webinars or whatever. And it's not the same, but okay, it's the only way we can do it. As soon as we can, we will start traveling again. Now, why we do these companies? Because we provide a lot of importance to the governance issue. For us, it's a very impressive, and you need it. Is a red flag that the management has to be long-term oriented. So most of these meetings are helping us to identify if they are long-term oriented or no. We know them, but of course, but what they have done in the past. But when we talk to them, we get to know. You would consider that doing so many company meetings in all these years, some of the meetings not concluent, you know, but some of them, believe me, are very concluent, both in positive and in negative terms. If we consider that the management is really long-term oriented, then we go on with the process. Now, what comes next is a fundamental valuation. We do a fundamental valuation of all our companies. We work in the sense that the value of the company is not a figure, you know, but an interval of figures. So this is the way we work. So there is a minimum evaluation and a maximum valuation that we use. And then, of course, in this fund, we have to do something different because we have to look at all these companies, which of them are providing service to these 300 places more visited by the tourists. So what does it mean? That if we are looking in Ireland, we are looking where is this airline flying, if it flies to these places or not. If we're looking hotels, we need to know where are the hotels located in these places or not. But it's not only a quantitative amount, it's also a qualitative thing, okay? So there are certain places when once one hotel has a certain location, it's unbeatable. No one can go after that. For instance, if you go to the nice city of Budapest and you want to be located in the old city, in the Buda part up, there is only one hotel there who is available, which is the Hilton Hotel. Hotel is there for historical reasons. No one can go there. No? So these kind of things, qualitative things, we are placing. Now, after all this process, here is in what we are investing. We call it the wheel of traveling, but at the end of the day, you could also call it the budget of the traveler, okay? So at the end of the day, we try to find out how is the traveler spending the budget before going out of traveling and when coming back, and where has he spent his money? So you are going to see that this is not a hotel and airlines, fund. No, it's not a tourist fund. It's a global tourist fund, but it's much broader than that. For instance, we can invest in companies. Here, some of them, all the names here are companies that we have already invested, okay? So for instance, when you plan the travel, you can use Booking, or you can buy a Samsonite suitcase, for instance, okay? So these are the kind of things that the traveler is using when they're traveling. But of course, you go to a travel hubs as well. For us, it's very important investing in airports. For instance, we invest in airport of Paris. Why? Because Paris is in this list. You will never see us invest in the, I don't know, in in other airports, like for instance, Frankfurt. No, this is a business trip. It's not a holiday trip, okay? And of course, we can invest in Dufry, companies which own almost 1/4 of all the shops in the airports, okay, worldwide. But then, for instance, if we go to Japan, we have companies like Central Japan Railway. If you go to Japan, first time, or even second, okay, everyone is taking the Shinkansen, at least from Tokyo to Kyoto or Tokyo to Osaka. And this is very well operated by this company, Central Japan Railway, who at most is giving amazing advantages if you are a tourist, more than if you are a local, okay? By the sea, of course, we can invest in companies like Carnival, cruises, normal cruises, but we can invest in companies like Lindblad Expeditions. This is a totally different cruises, 7 times more expensive than the normal ones, expeditionary type cruises. You know, it's like you go there to the Galapagos Islands or whatever with scientists, whatever. It's like a National Geographic type of cruise. Okay, of course, in flying, we can go invest in very long haul companies like Singapore Airlines, but also very successful models like Ryanair or Wizz Air. By the road, we can invest in motorhomes like Trigano, in SIX like companies rent a car, and much more in Autogrill that has a huge, network of shops within the, for instance, in Italy, in the highways in Italy, but as well in many airports in the US. Okay. Then of course we have hotels that have all kinds of brands, from luxury brands to normal brands like Meliá or Accor, but as well companies which are much more orientated to luxury like Mandarin or Shangri-La. And then of course, what's going on? This tourist is paying in cards, with cards, is Visa, or it could be with Alipay. Alipay is not listed. We hope it's listed someday. But of course, you can use TripAdvisor just to know where you go to eat, or you can go to Win Macau if you want to Macau and you want to play. So what I want to tell you is that this is the whole type of companies that we are investing. And it's a broad type. There is no benchmark available. This is not a leisure fund. This is not something like that. This is something unique that we're investing. So I hope that the rationale that we created the fund is clear enough for you at this moment in time. So now please let me, I pass you through Ignacio Hosta, who is our head of information or intelligence. He will tell you about the current situation of the industry. Come on, Ignacio.
Thank you, Jaume. Thank you for your presentation. When we're talking about recovering flights and capacity weekly, we need to talk about the total number of flights. When we see 2019, the total numbers of flights are 139,000. The minimum was in December 2020, 38,000 flights. Now the recuperation. In June 2020, we are about 60,000 flights. Now, June 2021, we are in 82. This is an increase of 50%. If we look by regions, we see Asia is 39 minus 2019, Europe 52, Middle East 35, and North America minus 18%. The global, we have minus 33%, and we have the recuperation month by month about 9%. We see the very recuperation in Europe month by month, especially Italy 31, France 47, Germany 27, and United Kingdom 12%. This is very important. In the next slide, please, Santiago, we ask, when we have planned to travel again. We talk about 1,050 consumers to travel 2 or more trips in 2019. And they ask 80% of consumers expect to take a trip in 2021. It's about, we see 29 has already in the plane, 30% expect to travel until June to September, and 22 expect to travel October to December 2021. The other ones, 9% in the first half 22 and 6% in the first half 22. Second half 22. But the most important is when we ask, when we check, you take to plane 2022, 85% want to fly in 2022. 1 or more to 55, and more than 2 flights, 30%. That's very important because this is a very good expectation to travel in 2022. When we see the next one, is the catch-up effect. When it's impossible to fly or to go anywhere, the savings are very high. This is the same in Europe and in the Eurozone, about 25%. The next slide is for me the best one. Santiago, please, if you have this one. This is fantastic because we see the extraordinary what's happened when the borders open. The 7 May, UK announced Portugal as to the green list. We see this enormous effect, about 600% of reserve. Jet2 and Jet2 holidays, for example, 60% 24 hours, and 1,300% compared to the next to the previous week. That is incredible. It's the same will happen now with UK permit to fly to the Balearic Island. We see the same with EasyJet and Ryanair, sorry. They had added more 6,000 seats to Mallorca, about 12,000 to Menorca, and 2,000 to Ibiza. That is very important because when we open the borders, the increase is very high. And you see this one in Portugal when the 7 May, and now with Spain, with the Balearic Islands, is start to open the 30 June. And the last one, sorry, Santiago, yes. When we're talking now about the Delta variants, because we have a lot of cases. But the most important is, this is for the young people, the number of cases increased like the second wave, but the hospitalizations and the death, they didn't expect. That is very important because we think this is very important to fly again in the next year. Now, please, thank you. Paul, that's the time.
Okay, thank you, Nacho. So basically what I'm going to do is to talk a little bit about my role and 2 of the studies that we made last year that we think are interesting to share. Basically what I do is to help and assist Jaume, the portfolio manager, in all type of research that, in companies, meeting with management and everything Jaume has already said, and also doing more general studies that we think might be interesting at any point of time. And the first one is this stress test analysis that we did back in March 2020 when COVID came. This is already a research that we do as part of the investment process, but COVID was a different situation, so we had to double check on that. Here, basically, we knew that COVID was a temporary shock, but we had to know if the companies in our portfolio were able or not to go through COVID. At the end, it was a huge impact, though temporal, but they had to shut down operations, close business, so we had to double check on that. Basically, here we look at everything in order to point out the more leveraged businesses or the companies in our portfolio that had more difficulties or would have more difficulties in order to survive this shock. And basically the important thing here was to find what strategic options the management of those companies might have in order to increase the liquidity and increase the solvency profile of their companies. At the end, and we have seen it all this year, they have postponed dividends, postponed future capital, some state liquidity help, raising debt, or even disposing some assets, which has been something really constant this year. For instance, cruise lanes, getting rid of old ships and keeping the more efficient ones and improving liquidity, or hotel companies like Meliá that they could dispose some hotels in order to increase liquidity, but doing a sale and leaseback and keeping the management and the business within these hotels. So we knew back then that our companies would be able to survive this shock. Also, an important part of this is that the governance part of the management and the shareholder that we study on the investment process really help us a lot here, because a lot of our companies are backed by strong families as shareholders, and this ensured us that companies would be able to get through this. Indeed, the reality has been even better than we might expect at first back in March 2020, because of the great capacity and ability that all these companies have had in order to get this additional funding needed in order to fund this impact. And talking about raising debt, but also the fact that only 9 out of 43 stocks in our portfolio needed a capital increase. This is quite successful. All of them were covered, and we were really optimistic when we saw a lot of opportunistic long-term investors entering the sector and investing strongly in the sector, from sovereign wealth funds to ultra net worth investors that took the chance and invested strongly in the sector at really low levels. On the next slide, this is the second study that I will share with you today, and maybe the more important one. This study was made on September 13th of 2020. Back then, so you can see here the net asset value of the fund in orange. This was a fund that since inception in 2014 was doing an internal rate of return on 9.92. Then COVID came, and you can see a huge impact and a huge decrease in the net asset value of the fund. And back then in September, what we wanted to do was to compare the valuation of every company that we have in our portfolio, adjusted by its weight, to its net asset value, therefore its market price. Back then, this has changed a lot with the announcement of the vaccines, but remind please that back then the sentiment was much worse than it is today. There were no announcement of vaccines yet, and there were some thoughts or hesitation about the future of tourism in the future. And we wanted basically, our idea was totally different. We were more optimistic, but we wanted, one, to double check that, and two, to show to our investors, to our customers in a graphic way what we were thinking about the current situation back in September 2020. Our opinion, as you know, was that COVID was a huge impact, but was temporal, and temporal crises have at the end low impact on a final valuation of a company that is valued on perpetuity. At the end, 1 or 2 years of not generating cash flows or even burning cash, like it has been the case in some of our companies, have little impact or lower impact to the final valuation compared to what the market was trading at. We valued, so basically you can see on the vertical line, that's the day we did the study. To do that, the study, we used 3 different scenarios. The first one is the consensus scenario, which is the blue one in the middle. We use here the consensus numbers and financials for our companies in order to do the valuation. The second one was our base scenario. To do that, we use our numbers, our valuation numbers. And as you can see, it was much more optimistic than the consensus one. And the third one in yellow is the pessimist scenario, that here basically what we wanted to reflect in the graph was some statement or sentiment that were on the market that days by some people that were saying that tourism was never coming back as before, and that it would take so longer to recover. That was not our opinion, but we wanted to also reflect that. So basically, the study reaffirmed our previous idea. The market had overreacted to the pandemic situation compared to the real impact in value to our companies, to the sector, and more specifically to our companies, which we thought back then as structural winners and companies that could come out even stronger than before the crisis in relative terms. For us, the rationale for this optimism was clear back then, and Jaume has already explained to you the long-term prospects of the future. But what we knew back then was that once the health situation allowed people to travel again, we knew that recovery would come stronger and immediately, just like Nacho has explained. So as you can see, here is the next slide. If you can go back a little bit, Santiago. Here, when we presented the study that day, we committed to all our investors that we would continue to present this graph, updating only the net asset value of the fund, so only the orange value. We committed that to see the valuation of the fund with the study we made last year, and importantly, without touching any of those valuation points that we made last September. So despite, for instance, nowadays sentiments regarding the industry has improved a lot, we have not touched any of those valuation points. Now, if we go to the next slide, here you can see the current situation today of the fund, with the net asset value updated. This big jump was the day that Pfizer announced their vaccine, where the fund increased by 17% in just one day. And for us, some may say that this fund has increased a lot this year, or it has recovered some part of the decrease it had due to COVID. But please take into account that back in September, when we did this study, our expected internal rate of return till the end of 2023 to the price or potential valuation price that we have from our basis scenario was 34.8, and still today, this expected internal rate of return is still 26.6%. Just to conclude my presentation, and as a reminder, if you and you can see it here on the graph, the net asset value of the fund has not even reached the consensus views of last September at the end of this year. And just imagine how these expectations and consensus views have changed from last September with no vaccines to today, where sentiment is much more optimistic. This was, as Jaume has said, a sector that is growing higher than world GDP, and this was a fund that was achieving internal rates of return higher than the MSCI World Index, and we believe it will continue to do so in the future after closing this valuation gap that we think already exists today. And with that, I pass through Jaume Puig that will talk you about the fund outlook for the following years.
Thank you so much, Paul. Okay, so let's go to some of the things that we have been doing within all this COVID situation, and of course let's talk a little bit about the future. Okay, first of all, a few words about what we have been doing. For instance, there were plenty of companies that we had in our radar and they were not passing through our valuation screen. Okay, for instance, one of them was Airbus. You know, here you see the company Airbus. It's a duopoly worldwide with Boeing, and for us it was cheap. Here in green, you can see the minimum valuation that we were giving to Airbus at that moment in time. And the red one is the maximum valuation that we were giving. As you can see, our maximum valuation was about 110 euros per share, and the stock was trading at about 140 euros per share. Of course, here we didn't own the stock. Okay. Now, what happened? The share of Airbus went down from 140 to 50 euros. Okay, it's even below 50 euros, which is huge. Okay, now much below this 90 euros per share that was our minimum. We have to tell you that after it happened, we did the valuation again of Airbus, and I need to tell you that that valuation was only lowered from 100, which is the midpoint, to 990. Okay, so the clear is a clear example of a company when there's an overreaction of the share price following much more than the valuation. What happened here? We bought plenty of Airbus here. Now, as you can see, if we compare it with the previous situation, now it's in the higher range of our previous valuation. Now, what we have been doing, we have been diminishing the weight of Airbus in the portfolio. So it's still there, but it's less than this. Now it's less than 0.5. It's about 0.4 weight as a whole. So as soon as the company is going up or the share price is going up, we're reducing the stake in the company, but we're still invested in the company. Okay, so we can see another example that companies that we added. Okay, so here it was Veneto. Veneto is a French company. That's a small cap that we know very much from ages. We have been talking to the company many times, and Veneto is just with yachts. You know, they do this kind of yachts. Okay, yeah. They have different branches. Okay. Now, what happened? Well, it was trading here approximately at 10 whatever euros just before the COVID crisis, but then suddenly it went below 5 euros. Okay. Now, our central case here, the minimum is between 12.5 and maximum 14. This is our range, you know, of valuation range. What happened? Of course, we took profit of the situation. We bought a lot of Veneto. That's an amazing company. It was an amazing company before, and it's an amazing company today. Nothing changed. Nothing justified the price being to 5 euros. Okay. So now, as you can see here, now is again approaching the higher end of our valuation. Now, this case is the same that we have been doing with Airbus. It's with a very low percentage today. It's lower than 0.5%, as well as the case of Airbus. Just because the recovery has been so huge, we took profit of the situation and we still keep it. And it's certainly in order to sell it, the price should be higher, and then we would sell it completely. Okay. Another company that we added is the French company GVC, which is a family-owned company as well. Okay. This is an amazing company. You know it for sure. You have seen everywhere and in all the cities worldwide, you see all the publicity items. So what happened? Well, it was approximately close, trading close to our valuation just before the COVID. Suddenly the company fell a lot. You know, this is a very good company, amazing company, okay? And we decided to increase positions. If you see from that time until today, the stock is heavily up. So we're earning a lot of money in the stock, but it's still below our what we consider to be the fair valuation, the lowest range. So here we keep a little bit more than 2% in the fund. So in order to sell, the way that we manage is very simple. The highest the discount, the fundamental discount valuation is there, the highest percentage that we own. Okay, so here, as I said, we have more than 2%. But anyhow, if we go on with the presentation, we can see that many things happened. We are very proud that most of the companies that we owned before the COVID were in the right, way of the equation. For instance, here you have 1/6 of hers. You know, we owned 6 and we didn't own a single share of hers. Now, why? What was that? Because the business model from these two, you might think it's the same, it's totally different. Okay. For instance, 6 is much more oriented to quality. 50% of the cars belong to luxury brands, for instance. They are more in the city centers, whatever. But there is something very impressive, that the deals that they have with the OEMs. Now, when they buy, for instance, today they buy 10,000 cars and they have these cars sold in 6 months' time. So the very moment they buy it. So for them, when crisis came, what happened for them? Okay, they just returned the cars, and every every car is about 30,000 euros per average. So if you return 10,000 cars at 30,000 euros per car, these are 300 million euros that you get back in cash. You know, so and of course they have much more the renting, which is that they do these models of renting, sharing, right, and subscription model, which is beginning. It began in Germany last year. Okay. Now, what we can see here is the following. Okay. So sixth, with this model is much more resilient. Sixth, believe me as well, is another family-owned company. Mr. Six is the family Six is the owner of the company. And I need to tell you that, for instance, we own the 6 preference shares, not the ordinary ones. For us, here we find out that the huge discount is in the preference shares. Okay, but now what happened in the same time? Okay, Hearth is with Chapter 11, okay, and Sixth is not only doing best things, but profiting from the Hearth Chapter 11. So Six, because of the Hearth Chapter 11, is increasing their position, even in Germany, which is very strong, in Europe, which is very strong, but as well in the US, where Sixth has a very tiny position because they started very late in the US. But for instance, because of Hearst, the Hearst bankruptcy, they were able to buy 7 airports that before this was operated by Hearst. Okay. Now, what's going on? Well, if we look at the 6 prices, pre-COVID and post-COVID, end of June, the share is up. And if we look, for instance, at Hearst, as you know, the Hearst is heavily down. So this is another thing of the proven business model that we were able to detect just before the COVID. Many things of this happened. We were invested in TUI, not in Thomas Cook. For instance, you can see what happened with the cruise industries between Carnival or Pullmantur being bankrupt, but Carnival profiting from this. Now, we had as well, one of the great successes of COVID has been Trigano, the #1 motorhome builder in Europe, #1 by far. Okay, so as you can see, they are absolutely, they're in historical maximums of everything. And then we were betting just before with this proven profitability business models like the low-cost carriers, Ryanair, Wizz Air, amazing companies. Even after the COVID, these are more winners than they were just before the COVID. All the profits of these companies post-COVID are going to be much, much higher than the net profits that they had pre-COVID. Okay, I told before about this valuation, new additions. But we have been doing a lot of bargain hunting. A lot of institutional clients have been doing this as well. for instance, but adding positions in number one, in top companies worldwide, like Carnival or Dufry or whatever. And just before, I don't want to bother you with all the change in the subsectors of the fund we have done, because there have done many of changes between pre-crisis and post-crisis. But the most important thing is that there is one specific sector, which is the airports. Okay, we have listed airports. For instance, before I talk about the airports of Paris, but we have as well airports of Thailand. We have AENA as well in Spain. And the thing is the following: this sector is normally a very expensive sector, and because of COVID, it has become extremely cheap, because all their figures are going to come back. Okay, and then we have been increasing, for instance, pre-COVID from post-COVID, the number of airports in our portfolios from 7.9% of our portfolio to 11.8%. So at the end of the day, all these things that have happened through COVID within the sector have been able for the portfolio manager in order to take profit of this situation and maximize the situation of the fund. Okay. Now, another thing that happened to us was a bit. Okay, we own a Dunkin Brands because this is a small piece in our fund, but of course, food and beverage is there, and we have identified that many people, when going out, likes to go to known brands, you know, and when for instance, and so American guys coming to Europe and going to Starbucks cafe. Okay, just because they are very familiar with this and this kind of things. Okay, one of the companies we own was Dunkin Brands, that you know the brand perfectly well. We had a bid last year, in October last year. Inspired Brands made a bid. They were paying in cash 20% more than the previous price. We thought that the price was fair and we accepted the bid. Okay. Now, this is the second bid that we have had in our history of the fund, because if we go to next slide, we're going to see another company that we had the bid. This was a very small company, Italian company. Nobody knew it, you know. It was called S.G.I.I.C. They operated the two airports close to Venice, the Marco Polo, which is close to Venice, and the Treviso one, which is 30 to 40 kilometers from Venice. But certainly, if you went to Venice, you went to one or to another by plane. Now, we had this. Nobody was looking at this company. We were buying it at 12 euros per share, and then finally there was a bid in 2017 at 21 euros per share, which was fair. Okay, so small companies that most of the people didn't know, but Venice, as you can imagine, is on this list, so it's very convenient for the fund. Okay, now we know that after the crisis, okay, the sector performs well. Here you have just after the Lehman Brothers crisis, the huge Lehman Brothers crisis, and here we have the sectors. Okay, we didn't have the fund by 2009, as I said, we created it in 2014. But anyway, here you can see, for instance, that the hotels index was up. Well, if you put in analyzed terms, 16% from 2009 to 2019, much more than even the GDP world. Here you have the MSCI World, which was up 14.8%. But you can see here, for instance, the hotels plus cruises, which was up 24.4% per annum. Okay, and you can see here airlines were performing a little bit less, but 9.5. So we know that after the crisis, things get better in this kind of sectors. But then, if we jump to the next slide, let me explain you have a lot of worries about reflation rate. Okay, we do think it's not today, we're not going to talk about this, but we think that we are facing a normalization of inflation. Okay, so not to hyperinflation, huge inflation, but not anymore to lower inflation as we had in the past. Okay, I tell you this, it's not the purpose of today. We could be talking about this 1 hour, but our investment case is that the inflation is just normalizing, not in 2021, but in the next 5 to 10 years. Okay, we see a lot of at the micro level, we see a lot of companies just passing through prices, asking for new debt in order to invest in new businesses instead of using cash. So it means that the multiplier is working, you know, that the monetary mass is growing, or supply is growing much more than the monetary base. So we see a lot of these things. But let's ask if this is the environment, what's going on with the tourist sector. Okay, now there are two main things that are very important to the tourist sector. One is the oil price. As you know, this sector is very oil consumption. It consumes a lot of oil, but as you can see, there is a level of oil that is worries us, is when we reach the $94 per barrel. Why? Because here you have in the calculation, but it's very simple calculation. Every time that the invoice of oil has been more than 4% of the GDP of the world, now what happens at this moment is that the world enters into a problem because it's too expensive. So it's like there is a certain amount of oil price that you can afford, and from this up more than this you enter into trouble. So now we are at 76. Our assumption from this year 21 is 75 as an average. Okay, it was below the average almost the first half of the year. Now it could be above the average, but we're expecting this average of 75. So for the moment the oil price is not a concern, and more if we look at the way that all the OPEC plus countries are behaving. Okay, so in a very moderate way, just not offering a lot of supply at the same time, but just wondering I mean, a little bit about the prices. Okay, now what about the global economy of and the corporate profits? Well, there is a level that we very much look, that historically every time that corporate profits are below this 2.5 2.6%, if the GDP is growing less than this 2.5 2.6, corporate profits enter into a problem, a trouble. Now, of course, as you can see, of course, last year was very exceptional. The world decreased 4.9%, but if you look at this year and next year's, this year is more than 5%, 5.4% growth. So the levels of growth that you're facing for today and for the future are well above the levels that we are very comfortable. So for the moment, we don't see any of these macro things that are the ones that we are facing the most within the industry. They are not worrying at all at us. If we have inflation, some sectors are going to suffer a lot. You know which kind of sectors are going to suffer a lot, but this is not the case of the travel industry. Okay, now let's go recovery pace. Okay, well, here, as you know, we have invested in many subsectors within the industry. Okay, so let me explain you one and then the whole pitch of the whole fund. Okay, so for instance, here you see the airline travel. Okay, as you can see here, this was sourced when we had a conversation with Aeroporto di Bologna, one of the companies that we were talking a few months ago. Okay, now if you look at this, what they are saying about the flight is the following. Well, this is a McKinsey report. Okay, the following is the following. So if you look at leisure, so if you look at the three types of people traveling, in this case by airlines, and leisure is the first one going to recover. So from 100 level in 2019, it was heavily hit last year, only 29, this year 60, but recovering and matching again the 100 level in 2024. If we look at the other type of, which is, visitors, visiting friends, relatives, this kind of reasons why to take a plane. Of course, this didn't fall so much, so from 100 to 41, but as well recovering at a good pace, which is the triumph level which is recovering the last is the business travel. Okay, so business travel, you can see here from 100 to 32, but taking a lot of time to recover. And within business travel, we can distinguish between the individual business travel and the collective business travel, but this is not the purpose. No? So what we see is that leisure is recovering first. We see, for instance, this very much when we talk to hotels. For instance, when we talk to Meliá, which they have a lot of vacational hotels, or when we talk to NH, we have more than vacational. they have some of them, but mall is in cities, you know, it's very different situation between one and another. Nacho Hosta was telling you before what happened when the Portugal was up, well, was considered green line by UK, you know, all this short period of time. Okay, we know hotels, hotels owners in El Algarve, and they were with these days, they had much more occupation than they had in 2019. So we know how fast it goes. But okay, I cannot be talking about all of the subsectors, you know, or we would be here at least for a couple of hours, and we only have a few minutes left. So let's go. Let me highlight what we are saying. Number one, post-COVID EBITDA margin is going to be higher than pre-COVID EBITDA margin. We are seeing this in many, many industries, but as well in the travel industry. If we look at the weighted EBITDA margin of our portfolio, of our current portfolio, the margin pre-COVID was 28.5%. That's an average, of course. And now we expect to be in 2025, 30.1. This means that the margin is going to be 160 basis points margin increase post-COVID better than pre-COVID. This is a general trend, okay? We have been observing this with companies in different sectors, but in this case is exactly the same. Now, this is facing something that's very important, that many people is asking, when is the sector recovering sales, you know? And this is very tricky, because sales is the last to recover. Because if here we have, this belongs to our fund, all our positions, the first to recover is the net profit of the companies. Then the EBITDA margin, quite close. The EBITDA, a little bit, sorry, if you can go, stay, okay, yeah. The EBITDA, and then the EPS. The EPS, of course, is recovering later than the net profit because of all the net issuance of new shares that have been done, okay? But at the end of the day, the last to recover are the sales, and the first to recover is the profit. But of course, we're talking about only when this is going to be recovered. But the thing that's more important for us is not when, is the amount. Because, for instance, if you are fully recovering everything in 2030, okay, but when you recover, you are selling 20% more than you were recovering in 2019, of course, you are recovering in 2020, but the most important thing is the amount. And that's with what we have in next slide, okay? So, now, according to our figures, the market cap of the companies that we own in the fund in December 19, okay, is going to increase from December 19 to December 25 more than 51%, almost 52%. Now, it's compounded of three different, concepts. First of all, results increase. The results of the industry in 2025 are going to be much, much higher than the results in 2019. It's a 60% more. Of course, we have to take into consideration the increasing number of shares as a whole, which is diminishing, -6% in our case. And we also take into consideration that multiples is going to be some kind of multiple normalization, because the industry in 2025 is going to be in a much higher position than it was in 2019 pre-COVID. Okay, now, if we apply this to our fundamental view in 2015, it means the following, okay? That today the institutional net asset value of the institutional class, the one that we're talking today, is close to 15 euros, okay? Now, we think that in 2025, at least it's going to be about from 26 euros to 35 euros. So that's an enormous IRR from now to 2025. Of course, our own figure is before, Paul was mentioning to you all the three different scenarios that we did. Our own figure is the one that we rely the most, and we expect the net asset value of the fund be closer to 35 by the end of 25. Of course, if you see at all the recovery in sales, in EBITDA, in EPS, whatever, if you see this, when is the right moment to try to profit this as an investor? Well, we think it's now. It was, of course, when we mentioned this at the end of September, but even the huge increase of the net asset value since then, we think that this is still the beginning. Because why? At the end of the day, take into consideration that for us, number one, the long-term rationale of the fund is absolutely intact. Absolutely there is no difference from the future to the past. And the second thing is that most of the companies inside get into a much better position. So if you wait to invest into the fund until everything gets fully normalized, it will probably be too late. Okay. Now, if you want to next slide, we can see, of course, the ESG. We have to look at the ESG, but let us tell you how we look at ESG. Okay, for us, the most important thing in ESG is the improvement trend of ESG. Here you can see the portfolio Bloomberg ESG disclosure score. And for us, the most important thing is how the industry is doing things better. Because at the end of the day, if you look, for instance, at what's going on in a few years' time, the most important thing is who are the industries who are going to contribute the most to the non-increase of the temperature worldwide. All these industries which are already there and are spending a lot of money in improving everything. We have an amazing graph of how was the consumption in the airlines just 30 to 40 years ago, and which is the consumption today. It's less than 90%. It's amazing. Okay, so our approach is this one. Now, here you can see we have today 43 holdings. Here you can see the distribution in subsectors, whatever. And then let me explain you a little bit more, not only this, you can look at this in the presentation as you have, but let me explain you a little bit because I have to tell you about capital asset management, okay? The Japanese, asset manager. So they believe in our strategy since the very beginning. They saw it. They launched this fund in Japan, which is called World Tourism Fund. It's amazing. They launched it in July 19. So here, as you can see, they didn't have we had all our history before, but not them. No? And it's amazing because, as you can see, the fund was doing only a little thing, of course. And then 7 months after launching the fund, you have the pandemic. So it's huge. It fell down. But the amazing thing with all all our friends of capital asset management, because they are extremely professional, is the great job they have done. Just please compare the green one, which is the NAP, the net asset value, and with the orange one, which is the asset under management. It was falling a lot, all the net asset value, and starting to enter money into the fund. So Japanese investors have been very, very smart, taking profit of this situation, understanding that long term is as it was, and fully understanding the situation. But now here you can see both things. Okay, so we are very proud of this collaboration that we are doing with capital asset management in Japan, and very proud of this, and it's a absolutely very professional way of doing things. Okay, now here you can see our fund, which is the one that we created in 2014, the Spanish fund. Here you can see the evolution, the fall, but as well, what we see here is in this kind of green blue is the net asset value of the fund, and in orange you see the assets under management of the fund just growing a lot. Now, what we think is that after this is that the moment is amazing today. The borders, everything is still, you have still plenty of restrictions about it. And just to finish, let me remind you something that is behind all this, but it was a Brazilian friend of mine. Well, one friend of mine who is living in Brazil, okay, who told me this, and just let me share it with you, because this is our approach with this. Yeah, you know, in the huge Spanish flu in 1918, you know, that was amazing. That killed 2.7% of the world population. If today it has happened something similar, the number of deaths all over the world should have been more than 200 million. Okay, that was amazing. It was crazy. But that friend of mine told me, look, do you know what happened with the Carnival in Rio de Janeiro? And he mentioned to me the following. He told me, look, in 1918, it had to be suspended. Okay, they couldn't do it. And normally the Carnival in Rio de Janeiro is lasting for 6 days. Okay, he told me, you know what happened in 19? That this Carnival lasted for 3 months, and even today is considered to be the longest and largest carnival in history. Okay, so having said that, I mean, you have in the presentation more slides about companies, but it's just if you want to do some Q&A, all of us will be more than happy to ask you.
Thank you very much to all of you who have been participating in this webinar. We are really convinced that this is a good time to invest in the sector, and we encourage you to invest in the fund. Jaume, Paul, Nacho, Santiago, and I will be happy to assist if you need any more information. Thank you. Thank you.
Thank you. Arigatou gozaimashita. Thank you.
Thank you so much.
Thank you. Thank you.
Thanks. Bye.